Module 2, the term sheet. Unit 1, the term sheet overview. The term sheet is a blueprint of your future relationship with your investor. The two main things that VCs care about in investments is economics and control. When companies are created, the founders receive common stock. However, when VCs invest in companies, they purchase equity and they mostly receive preferred stock. Preferred stock is a special bundle, as the holder of preferred stock typically can unilaterally decide to convert to common stock and give up all these special rights. But once preferred stock converts to common, it cannot go back or be reverted. Unit 2, economic concepts in the term sheet. The first economic concept is valuation and price. The valuation that you and your VC agree to impacts much of the business you are selling and the level of dilution you'll be accepting in the financing package. The valuation determines the price per share at which you will sell your stock. The pre-money valuation is what the potential investor is valuing the company as of today prior to investing. The post-money valuation is essentially the pre-money valuation plus the envisioned aggregate investment figure. Not to worry, here is an example. If you raise $1 million at a $3 million pre-money valuation, your post-money valuation is $4 million. The second concept is employee option pool. In most cases, companies want to make sure that they have sufficient equity or stock options reserved to compensate and motivate their workforce. A large employee option pool can lower the actual pre-money valuation and is another common valuation trap. For instance, assuming you're considering a $5 million investment at a $20 million pre-money valuation, and you have an existing option pool of $10 million of the outstanding stock reserved and is yet to be issued. However, the VCs suggest that they want to see a 20% option pool. In this scenario, the excess 10% will come out of the pre-money valuation. This results in a pre-money valuation of $18 million as opposed to $20 million previously. The third aspect is warrants. A warrant essentially gives an investor the right to purchase a certain number of shares at a preferred price for a certain number of years. For example, a 5-year warrant for 50,000 shares of Series A stock at $2 gives the warrant holder the option to buy 50,000 shares of Series A stock at $2 per share at any time over the 5-year period. This is regardless to the stock value at the moment of exercising the warrant. If you want to possibly eliminate the need for negotiating warrants in the fundraising round, you can negotiate a lower pre-money valuation. This helps to reduce the incentive of existing investors using warrants to artificially inflate the valuation, as it has potential to affect the future allocation of proceeds in a liquidity event. Moreover, a bridge loan is a type of financing where warrants are commonly used. A bridge loan happens when an investor is planning to do a financing but is waiting for additional investors to participate. In the bridge loan situation, the existing investors will make the investment as a convertible debt, which will convert into equity at the price of the upcoming financing. As a bridge loan investor took additional risk, he or she generally gets a discount on the price of the equity, say up to 20% or more in some cases. The fourth aspect is the liquidity preference. The liquidity preference concept dictates a certain multiple threshold of the original investment per share is returned to the investor before the common stock receives consideration. The next issue here is to determine if the investors' shares are participating. With participating stock, the investors will get their preference, but also will receive additional proceeds after the preference is returned. Generally, there are 3 varieties of participation. Number 1, no participation. Number 2, full participation. And number 3, capped participation. It is most common for preference shares to convert to common on a 1-to-1 ratio to allow them to take part in the proceeds of a liquidity event. For example, if an investor buys $10 million at a 1 times liquidation preference on a non-participating preferred stock, and the company later sells for $200 million, then the investor will receive exactly $10 million back if they elect to take their liquidation preference. Assuming the $10 million investment represented a 20% stake, in this case, it is wise the investor converts to common and takes 20% of the proceeds, that is $40 million. Generally, the preference here would have provided downside protection for the investors, especially where the 20% ownership will be less than their investment. On the extreme end of the spectrum is a fully participation preferred stock. In this scenario, the stock will receive its liquidation preference, say 1x or 1 times, and then the liquidation proceeds as converted to common. So in a $200 million exit, the investor receives his initial $10 million to meet the 1x threshold and another 20% of the remaining $190 million. In this case, the investor receives the $10 million plus 20% of 190, that is $38 million, and he totals a $48 million exit. 5. Vesting. When an employee is granted a stock option, they don't get the entire award on the first day. Vesting typically are stock options that allow employees to receive a portion of stock over a period of time when they serve the company. In most cases, stock options will vest over 4 years with a 1-year cliff. So in a 4-year scenario, each year the employee receives 25%, but the 1-year cliff means they will receive the full 25% at the end of year 1, and after that, the stock would be vesting on a pro rata basis, either quarterly or monthly, during the period of their employment. Unit 3. Control concepts in the term sheet. The first control aspect in a term sheet is the board of directors. Typically, investors would want to influence the composition of the board, plus number of seats, types of approvals the board will make, and the decisions they will have veto over the founder. For larger investors, they would expressly require a seat in the board. The second aspect of control is protective provisions. These are typically veto rights that investors have on certain actions by the company. For instance, acquisitions, going public such as IPOs, selling of strategic assets, or hiring of key staff, for example, replacement of the CEO. Drag-along agreements. This is a third aspect of control. In this specific provision, the company will not want a specific shareholder to vote his shares in whatever way the shareholder wants, but rather to have the shares voted in a certain investor or class of investors. For instance, if you are a preferred investor, you would vote in a similar manner or pattern to the other preferred investors. If you are a common investor and say you are a founder who left, you would be voting in a similar manner to the common investors that have remained. Unit 4. Other terms in the term sheet. The first term in the term sheets that are also included includes dividends. Dividends are mostly a common term to larger or late-stage investors or VCs that have a private equity inclination. The second aspect is redemption rights. These allow investors to sell their shares back to the company for a guaranteed return. It provides investors with additional downside protection, especially where there is no liquidity in the market. The third aspect is conditions precedent to financing. These are the things that need to happen before a deal is closed, and it stipulates the role of the founder or the company in facilitating these CPs. Other aspects include information rights, right to first refusal, also known as pro rata rights, voting rights, restrictions on sales, a no-shop agreement, and indemnification or protection from liability for key stakeholders such as the board and investors. Unit 5, Letters of Intent, the term sheet alternative. A letter of intent is an alternative way to capture key terms. It may look like an MOU in some cases, or in some cases may be a high-level brief or document prior to issuance of the term sheet. In some cases, it may outline the structure of the transaction or the deal, and it may also specify key aspects such as, is the transaction an asset versus a stock deal, for instance. However, there are aspects that are recurring. For instance, representation warranties and indemnification clauses may be one such aspect. LOIs or letters of intent may also have NDA clauses or non-disclosure agreement aspects, as well as conditions required to close. For instance, there should be no material adverse change during the due diligence process. Or for instance, the company needs to have settled any outstanding litigation that may be present prior to the funding. The other aspect that may be included in the LOI is the types of fees for the transaction during the due diligence or the post-due diligence phase.